Our title for the webinar today is "The 60/40 Portfolio is Dead." So it's a little bit of a provocative title, and actually we have learned a lot from the 60/40 portfolio. There's a lot of good things about it, but we want to see if maybe we can't improve it as well. So that's really what this is about. And in fact, the dynamic part, why dynamic portfolios are better, is the important thing. We don't want to keep that 60/40 always fixed at 60/40. So before I dig in too far, we have to get a few disclaimers out of the way. Lucena Research does not provide investing advice. We're not an advisory service. Do not assume that the methods we're going to present here are profitable. Again, remember that past performance is not predictive of future performance. And the results that we're going to show here are hypothetical. Okay, so I'm your presenter. I'm Tucker Balch. I'm a professor at Georgia Institute of Technology, where I teach courses in artificial intelligence and finance. I've published a lot of papers in robotics, and over the last 5 years, I've been transitioning from robotics to finance and helped co-found this company, Lucena Research, with Ares Katz. I used to be in the Air Force. I want to thank also Scott Strong, who has contributed a lot of the data that you're going to see in this presentation. Now I want to mention a little bit overview of Lucena Research. We've got 4 main products, one of which that you'll see, several of which you'll see today. Our flagship is the QuantDesk cloud-based decision support system. We also provide alpha templates, which are data feeds that folks can use to integrate with their existing practice. We have premium delivery, where we provide specific model portfolios. And in fact, the thing I'm going to overview today is a model portfolio. It's one of the premium delivery products. And finally, Quant for Hire, where we work with you directly to help shape your strategy. One thing I want to invite is to invite you to ask questions as we go along, and we'll pay attention to those and get to them as we go forward. Anyhow, recapping, we're going to look a little bit at QuantDesk and also at premium delivery, in particular the strategy that we're looking at today. Okay, so getting back to our provocative title about the 60/40 portfolio being dead, let's talk a little bit about the 60/40 portfolio. Okay, so the 60/40 portfolio has been around for a long time. It's been recommended by wealth managers for decades. The general idea, as I'm sure many of you know, is that you allocate 60% to stocks, 40% to bonds or some other form of fixed income, and rebalance that annually. It's performed very well for a long time. If you look just back to 1990, about 10% annually, 1990 to 2011. Why is this a popular approach? Probably the most important reason is it ensures diversification into the 2 most important asset classes in the U.S., 2 most liquid, and if you look at all the potential asset classes, these are the 2 most diverse. Now, you should, of course, further diversify within those individual asset classes, but if you're 60/40 stocks and bonds, at least you're diversified across the 2 most important ones. It's also weighted in favor of equities, and if you look at history, those have performed very nicely. And so weighting in favor of equities is preferred if you're going to have some sort of fixed weighting. Now, one of the key things we're going to talk about here is probably that weighting shouldn't be fixed. But in any case, if it's going to be fixed, it ought to be fixed in favor of equities. The bond exposure is important because that provides a cushion when the market takes a significant downturn. Here's a back test of a 60-40 portfolio. On the right there, the green line represents the performance of the 60-40 portfolio. The purple is the overall market, the S&P 500 total return index. And as you can see, since 2005, it underperformed in terms of total return in the first few years, but it survived through the downturn a bit better than the overall market. And since the market bottom in 2009, it's performed about as well as the market. An important factor to consider there is that its volatility has been much lower, but the total return has not been as significant. Now I'm going to take a few moments to show you how we can run a backtest like this in QuantDesk. This is QuantDesk, which is our cloud-based platform, and we can backtest a lot of the things we're looking at today in QuantDesk. So we'll start with our 60-40 portfolio baseline. We're using, in this case, the two assets we're using are AGG, which is an ETF that is represents Barclays Aggregate Bond Index, which is one of the primary assets that folks use for bonds in the 60-40 portfolio, and SPY, which is an ETF that represents a cap-weighted version of the S&P 500 index. So what cap-weighted means, I'm sure many of you know, is that each holding is weighted according to its market capitalization. So companies like Apple and Google and Exxon represent a large portion of the SPY index. Now we can do a backtest of this using our optimizer, and we want to keep things at 60-40, so we can just input some constraints here. We want to have 39.9% bonds and 59.9% equities. We'll save that, and then we can backtest that over time going here. So our backtest now is running in the background, but I've already run it ahead of time, and I'll show you those results here. So this is the one that's running right now, but I ran it already quite some time ago. And here's the performance of the 60-40 portfolio in our backtester. And as you can see, so the orange line here represents the value of the portfolio, and blue is the S&P 500 total return. We can get a much more detailed look at it if we click on full report here, and that's what this looks like. And we can look at returns by year and note that it doesn't necessarily blast away the market each year, but it provides nice steady return, and in particular didn't see as strong a downturn in 2008 as the overall market. Let's compare a few of the important points about the 60-40 as it's been around for a long time, and what's good about it. First of all, it's got about half the volatility of the overall market. So 0.77% standard deviation daily compared to 1.32 for the market. So the market's almost twice as volatile as the 60-40 portfolio. When we look at the drawdown in 2008, 2009, the market overall lost 55% during that period, whereas the 60-40 portfolio only lost about 35%. so much better there. Also higher Sharpe ratio overall. So those are good performance metrics for the 60/40. Obviously, we don't capture as much return as we'd like, so we want to consider a few ways that we might be able to make this better. So can we construct a portfolio that's inspired by the 60/40 but does better? And our answer is yes. There's three ways we can make it better. One, and the first two are based on just picking better assets for this portfolio. We can pick better stocks, we can pick better fixed income, but the most important and the key point of this presentation is we can do a lot better by tactically allocating our assets based on what we think the overall market is going to do. In other words, we don't want to keep things fixed at 60/40. When we're in a bull market, we'd like to emphasize stocks a bit more. When we're in a bear market, we'd like to focus more on fixed income. The key question, and the one that what we're going to answer, is how do we know which kind of market we're in? And I think you'll be interested in that result. Okay, let's first focus a little bit on stocks, and we're going to draw a lot on Nobel Prize winning approaches. You don't need to just believe me because I'm a computer scientist. I want you to believe Nobel Prize winners like Harry Markowitz and Eugene Fama. It's not that complicated, but not everybody does it. So it's worthwhile to understand what these folks have discovered. So first of all, in the 60s and 70s, Harry Markowitz helped pioneer this approach called modern portfolio theory. Some of the key lessons from modern portfolio theory are the following. First of all, the overall market is represented by S&P 500, the cap-weighted index. And if you're going to deviate from that portfolio, the market portfolio, in other words, if you're going to do something other than invest in the whole market, it only makes sense if you know something. And the efficient markets hypothesis says essentially you can't know anything, so you ought to just invest in the overall market portfolio. An example of that investment is the ETF SPY, which invests in every member of the S&P 500 index, and it weights that investment according to the market capitalization of each stock. So like I said before, for instance, Apple, Exxon, and Google represent some of the largest components of that. This is, by the way, this research is where the whole idea of index investing came from, and why ETFs like SPY began to exist in the 80s and 90s, is that they provided a way for the normal investor to be able to invest in the whole market. It's a little bit difficult to buy 500 stocks and keep track of those in your portfolio, so they created these electronically traded funds, ETFs, as a way to enable that for you. Mutual funds are also a way that you can do that. Okay, so two other folks came along and they said, well, actually we can know something. The efficient markets hypothesis is still true, but there are some factors that can predict future outperformance for stocks. And this is from Fama and French. You may have heard of the Fama and French three-factor model. I won't go into all the nitty-gritty details of that, but key thing to remember here is that they discovered that small cap stocks outperform and that value stocks outperform. And they showed that over many years, and lots of people follow the Fama and French models. And let me just show you real quick some examples of this. Small cap and value were shown by Fama and French to have improved performance. Well, one way we can check on that is look at the history of this small cap value ETF, VBR. Over time, its value here is represented by the blue line, and the S&P 500 by the red line. So since the market bottom in 2009, we're seeing about 30% overperformance of VBR compared to the overall market. So all this is a rule-based investment strategy that focuses on small cap and value. There's other ways that you can emphasize value and smaller cap. Another good example is MDY, which is mid cap. Again, that's shown here in blue compared to the market in red. This ETF's been around a bit longer. Look at how much of a difference it's built between the overall market. Really strong outperform. So if you want to take advantage of what Fama and French said, you don't have to do any fancy stock picking. You can just select ETFs that overall within their portfolio tend to overweight small cap and value. One ETF that we've seen that does this well is RSP, which is a equal weight ETF. In other words, it holds everything in the S&P 500 in equal weight, and in comparison to the overall market represented by SPY, it ends up to some extent overweighting small cap because of the equal weight allocation. Anyways, you can see all three of these ETFs illustrate the added value in smaller cap and value-based investing. So yeah, we do know a little bit more than just what modern portfolio theory told us with Fama and French. Lesson learned here is we can improve our portfolio on the stock side very easily, just following what these Nobel Prize winners have told us, which is to add some representation of small cap and value to our portfolio. Okay, so that's the equity and the stock side. What about the fixed income side? Okay, so the traditional sort of recommended approach for the bond or fixed income side are these two ETFs, AGG and BND. Both of them are very good, and they track the Barclays U.S. Aggregate Bond Index, and that's a combination of treasuries, corporate bonds, municipal bonds, and so on. And when people think about bonds, they often think about the AGG ETF. So what does it look like? So here's a chart where we compare the S&P 500 versus AGG. AGG is in red and the S&P 500 is in blue. Now, as you can see, S&P 500 is a lot more volatile than AGG. AGG provides a nice, smooth increase in value over time, but clearly it's not as aggressive in bull markets as S&P 500. Anyhow, if you were to follow the traditional 60-40 portfolio, you'd have 40% of your holdings in AGG and 60% in S&P 500. So far, so good. One thing I want to point out, though, is that having your funds in AGG is not too much different than having it in cash. In other words, it's not working much for you. It's just providing sort of a reserve. And lots of people argue that the value of bonds is that when stock market goes down, bonds go up. If you look at this chart, we see that perhaps a little bit here, but overall, we're not seeing that AGG is very responsive to the market. So we can improve that. We can improve the fixed income side of our portfolio by selecting different assets. And here's an example of that improved group of assets. Again, the S&P 500 is represented by the blue line here. but our improved group of fixed income assets are represented by the red. Now, notice that indeed our improved fixed income group is more volatile than AGG. I'll just go back real quick for you to see that. Yes, it's more volatile, but notice how this group of assets is much more responsive to the market. We see this significant dive in 2008, 2009, and these fixed income assets rise in response. Again, a drop here and a rise here, and also in this area. Now, you might think, gee, that's more volatile. Having a more volatile asset in my portfolio makes it more volatile. Well, it turns out actually that if that asset that you add is anti-correlated with the rest of your portfolio, it actually gives you a lower volatility portfolio overall. So by selecting different fixed income assets, we can actually have a more responsive component of our portfolio. So to recap, we're suggesting let's select some different assets for the stock side, and let's select some different assets for the bond side, and overall we can have a better portfolio. Okay, how much better is it? Well, let's take a look real quick. So here's our baseline 60/40 portfolio, where it's composed of 60% SPY and 40% AGG. Well, here, if we use our new group of assets, we get this improved performance. So I'll jump back and forth between the two. So our new portfolio, just by changing the assets, we're looking at 122% return over this time period and a Sharpe ratio of 0.77. Our older plain 60/40 had a return of 78% and a Sharpe of 0.57. Here's the new one. Here's the old one. We have lower volatility, higher return, higher Sharpe ratio. One key thing to look at is R squared, which indicates how much of our portfolio's return is described by just what the market's been doing. It's only 0.57 for this new approach, whereas it was 0.94 for the original 60/40. So we're doing better in a lot of ways just by picking different assets. Remember, please feel free to add questions and we'll address them as we go along. Okay, so that must mean the 60/40 is still great, right? Well, yes, 60/40 is definitely a great way to invest, and if you pick your assets carefully, it can perform very well. But we can do even better, and that way to do better is tactical asset allocation. The most significant weakness in the 60/40 portfolio is that 60/40 part. It's always fixed at 60/40, and we'd like to do better. For instance, when the market's going up, we'd like to overemphasize stocks. When the market's going down, we'd like to overweight fixed income. How can we do that? How can we know whether we're in a bull market or a bear market, and how can we leverage that in our portfolio? That's the most important part of this of what we're talking about today. So our inspiration was to look at government data. One of our quants, Scott Strong, spent literally months looking at all sorts of federal government data, and there's a wealth of it out there, to see if he could discover factors that were predictive of the overall future market. We settled on the 10 most predictive. Here's 4 of them, just to give you a flavor of what we discovered. Continued claims on insured unemployment. In other words, when folks are continuing to file unemployment claims, that's bad. That's bad for the market. Delinquency rate on business loans, again, bad. Civilian employment to population ratio. And finally, total public debt as a percentage of GDP. These are just 4 of the 10, but all of these we discovered were predictive of future market performance. Now, this is long-term performance. It's not like what's going to happen to the market tomorrow. It's more like what does the outlook look over the next 6 months. So we took advantage of all these predictors and we combined them in the following way. We built 10 experts. What each expert did was it had responsibility for looking at, or it has responsibility for looking at one of these factors. Altogether, we have 10 of these, 10 such factors, and we developed a rule of thumb for each one. In other words, if, for instance, if you consider total public debt as a percent of GDP, if that's above a certain level, as a rule of thumb, that's bad. So in the case of bad votes, the experts that are voting bad produce a vote of 0. When things are good, they produce a vote of 1. And we weigh each of these experts according to how well in the past they predicted the future market. Then we sum up these votes, and that's our model. So what does it look like? Here's what this model looks like over time, all the way since 1988. So the top blue line there is the result of these votes. The bottom line is how the market performed. So a couple things to note here. This downturn here is the dot-com bust. Up here are the votes of our experts. And as you can see, they rapidly decline far before this, far before the market hits bottom. And in fact, most of them are voting negatively, even by the beginning of 2001. So if you were paying attention, if you knew this back then, you would be shifting your portfolio from stocks to fixed income, and you'd be mostly in fixed income by 2001, and you'd be able to survive this downturn more effectively. Let's look at the 2008-2009 downturn. Again, the overall model was down to 0 in early 2008, indicating it would be recommending strongly to be in fixed income early in 2008. In fact, it's recommending that fully all the way until just before 2001. Now, I'm sorry, 2010. Now note, in this great bull market, we've got strong positive votes, and we would be strongly in equities during this time, riding that bull market. So overall, here's how we take advantage of this model: is when this model has a result of 0, in other words, it's recommending fixed income, where 30% equities, 70% fixed income. When this model is voting 1, or 10 out of 10, we're 70% equities and 30% fixed income. So we vary between 30% equities and 70% equities according to this vote. Let me just state it more specifically. Again, 30% to 70% in stocks according to the voting result. Okay, how well does it work? Well, let's take a look again at some of our results in QuantDesk. So recall, this is our old 60/40 using AGG and SPY. So AGG, the aggregate bond index, and SPY, the S&P 500. Now, if all we do is pay attention to this, to our model, and we, for the moment, assume we just use, again, SPY and AGG, how well does that work? here's how well that works. So again, this is just using those same traditional 60/40 assets, but instead of being fixed 60/40, we're shifting it according to what our model says when it looks at those 10 factors. We shift from 30% equities to 70% equities, depending on what those factors say. So this is everything the same as the 60/40, except we're dynamically changing our allocation between the two. You can call this tactical asset allocation. Okay, we can do even better though if we use these better assets. So here is a comparison now if we use those improved assets. So over this time period, 143% return compared to 120%. Also notice, so again, these are using the old assets. This is using the new assets. So we get improved total return, we get improved Sharpe ratio, and very importantly, much lower volatility when we use these different asset classes and when we dynamically allocate according to what our market model says. So to summarize it, we can improve on the 60/40 portfolio in three ways. Most importantly is quit doing 60/40. You need to allocate dynamically. You need tactical asset allocation instead of just blindly 60/40. You need to select the stock aspect of your portfolio better. And finally, you need better instruments for fixed income. If you do all those three things together, you can have a much improved portfolio. Now, we've been trading this approach live for about 2 months. We've been trading just the straight strategy I described for you. It's outperformed the market in terms of total return, lower volatility, and higher Sharpe ratio, all the key metrics. We've also been trading it in a portfolio that includes custom selected stocks. That one's doing even better. We use the custom selected stocks as the equity portion, and then of course the fixed income we were talking about as the other side. Anyways, both of these live traded portfolios for the last 2 months have outperformed the market in terms of total return, lower volatility, and higher Sharpe ratio. We'd be glad to share those results with you if you're interested in learning more. How to learn more, send us an email at info@lucenaresearch.com. Also, you're welcome to follow my blog, which is augmentedtrader.wordpress.com. So I've shared with you some of the most important points, and to get the full details, please drop us an email, and we'll be glad to share those with you. Let me pause for a moment and see what we've got in terms of questions. Okay, so I'm looking at the questions, and I don't see a significant number of questions, but be glad to answer some if anybody wants to add them. Okay, so one of the questions is where do you enter and exit based on votes? So this is in reference to our macroeconomic model. The strategy I just presented, we're always in equities and we're always in fixed income. We just shift the weighting according to the votes. So if the votes are all the way down at 0, we're still 30% stocks, and of course the majority in that case is in fixed income. If the votes are all 10 out of 10, then we're 70% stocks and only 30% fixed income. There's a question about what are the new fixed income assets. That's one component of the strategy that we're keeping proprietary. Again, we'd love to share that with you if you want to follow up with us. And one of the products we offer is a model portfolio, and if you follow that, you'll see exactly what those assets are. Um, Another question is how often do we rebalance? All of the back tests I showed you are based on monthly rebalancing. We've run some back tests that show that it works still very well only with quarterly rebalancing. Uh, the in general, we see better performance with monthly rebalancing, but we understand there's lots of reasons folks might not want to rebalance that frequently. There's no gain by rebalancing more frequently than monthly. There's a question about the predictive factors in our macroeconomic model. In particular, are they published with the same frequency? Um, some of them are published biweekly, some of them monthly, some of them quarterly, and so some of the votes don't change so frequently. We combine them all together into a single result. I want to add that in our back testing, something that Scott Strong did that was very important is he was sure to date the information such that it represented in our back test that we didn't know anything historically before it was really published. So, for instance, a lot of these factors come out a month or weeks after the time period they actually represent. So if you're going to backtest with something like that, you got to be sure to prevent your algorithm from being able to see the results before they would actually be available to you. Another question, is this geared toward ETF selection or individual stocks? We've shown that it works with both approaches. And in fact, if you have strong insight in picking stocks, it can perhaps perform even better than using ETFs for the selection. But as a bare minimum, it makes a lot of sense to choose your ETFs carefully if you're investing in the overall market that way. And in particular, we've seen significant value in the ETFs that tend to weight the small cap value stocks more significantly. Please touch base with us here, and if we didn't address any of your questions, which we'll strive to do shortly, touch base with us. Or if you'd like to know more, we've got a white paper about this we'll be happy to share with you. Send us email at info@lucenaresearch.com. Thanks very much, everybody. Look forward to touching base with you by email. Again, we greatly appreciate your time, and drop us an email at info@lucenaresearch.com. Thanks very much.